When investors choose assets to form a well-performing, diversified portfolio, they look for three investment attributes. The first is strong returns. They need assets that will grow in value enough to fund their retirement. The second is stability. They need assets whose values will not fluctuate too strongly. And the third is diversification. They need assets that won't move together in value because low correlations will reduce the volatility of their overall portfolio. The U.S. stock market forms the cornerstone of most investors' portfolios. That means we can measure diversification potential using the correlation between a given investment and the broad domestic stock market. The other two key investment attributes, returns and stability, can be combined into a measure of risk-adjusted performance, such as the Sharpe ratio, which equals average excess total return divided by the standard deviation of monthly returns. The question is, which investments provide both strong risk-adjusted returns and diversification potential? To answer this, we start by plotting the Dow Jones-Wilshire 5000 Index, the most widely used measure of the broad U.S. stock market, on a graph showing its Sharpe ratio of risk-adjusted performance since 1992. Now, investors can choose other domestic stocks, including stock mutual funds and stock ETFs, according to a variety of investment styles, for example, small-cap growth stocks or large-cap value stocks. Here, we've plotted every index of a domestic stock market investment style for which we could get returns as far back as 1993. Risk-adjusted returns are shown vertically, so investors want to choose assets near the top of the graph. Diversification potential is shown horizontally, and investors want low correlations with the broad stock market, so they want to choose assets near the left side of the graph. As you can see, while some stock market investment styles have provided stronger risk-adjusted performance than others, none of them has a correlation less than 75%. That means that investors cannot use stock market investment styles to effectively diversify their portfolio. But that doesn't mean investors have to accept low bond returns or high commodity volatility to achieve portfolio diversification. Here, we've added U.S. REITs to the asset mix, and right away you see that REITs offer both strong risk-adjusted returns and diversification power. Since the end of 1992, the total return on equity REITs has averaged more than 12% per year, compared to less than 10% per year for the broad U.S. stock market. And those 15 years haven't been a fluke. Since 1972, the average total return on equity REITs has been almost 13%, compared to less than 11% for the broad stock market. Meanwhile, equity REITs have been no more volatile than the stock market, which is why their risk-adjusted performance is so much better. And the average correlation between equity REITs and the stock market has been only 38%, meaning that REITs provide crucial portfolio diversification. In fact, the investment research company Ibbotson Associates has estimated that, since 1990, investors who allocated about 20% of their overall portfolio to REITs could have enjoyed higher portfolio returns with lower portfolio volatility than those who didn't invest in REITs or who had smaller portfolio allocations.